My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is the man who was born with his birth certificate as car dealership, first name and last name Guy, car dealership guy.
I love it.
I know you want to say anonymous car dealership guy. I think I'm just going to call you CDG to make things easier. But introduce yourself to the audience to the extent that you're comfortable as far as who you are, your background, and why the focus on Twitter. You've gotten some serious engagement lately.
Thank you, Michael. Look, my background, lifelong car guy, grew up in the car business, working through pretty much every part of a dealership. And then over time, worked into ownership, executive management, raised institutional capital to grow the business. And so have really seen the business from the perspective of, a lot attendant, a salesperson, all the way through a CEO and working with institutional capital and the boardroom. And so that's allowed me to sort of morph the two different perspectives, but ultimately just to communicate what I'm seeing in a simple way for the everyday person, but also have enough sophistication where it keeps it interesting and people are really able to get a good idea of what is really happening in the car business. So that's more or less my background. Why Twitter? Why am I doing this? Well, I started that account for fun. I was inspired by a strip mall guy who's now a really good friend, and he started a real estate focused account at the time. And I said, well, I know quite a lot about this industry. Maybe someone will care. And I realized that people really do care because it's a very opaque industry, and people don't know what's going on in the car business, and they don't know kind of what happens behind the scenes. And it's been extremely fluid over the last couple of years. And so I said, well, you know what? I'm just going to start sharing what I know. And obviously from there, I took it to many different directions. I started launching different forms of media. I recently launched a podcast, which, we nearly broke top 100 this week in US nationwide. So it's extremely exciting. And something again that I never even planned on doing. So, just excited to see where this account goes and the brand really over the next couple of years. But just here to share as much info as I can with everyone. And with the goal of becoming this trusted voice in the car business where people can get the latest news before anywhere else.
Since you mentioned your start on the sales side, I'm curious to hear how the selling process has evolved and changed over the years. I mean, obviously with more information, people probably have already a mindset as far as what brand and what make of a car they want to buy, whereas maybe in the past it was more about the salesman's skills in terms of communicating. How has the sort of selling process evolved over the last several years?
Yeah, so you'd be surprised. I mean, first of all, most customers, and I say close to 100% of people nowadays do some form of research or interaction online with a dealership before they come in. So we're definitely at maturity there where everyone is touching the internet before coming to the dealership, or at least almost everyone. Surprisingly, you still see that regardless of how much people go through the process online. There's still a big aspect or portion of people that just want to speak with a human. And so I think that the goal is where can you, like, I'll give you one example that I always found fascinating, but I forget the exact stat, but Carvana's call center, Carvana, right? The digital way to buy a car or the online way to buy a car is absolutely massive. It's like one of their biggest departments or something. And so the point here being that, yes, like people will buy online or they want to do a large portion of the transaction online, but they're still making a large purchase, $20,000, $30,000, $40,000. And, you want to at least, be in touch with a human at certain points, or at least whenever you want to speak with a human, right? Not through a negotiation or something maybe, but at a certain point just to get comfortable. So I think one thing that's really interesting when I launched the account, again, I just love testing different things. It's just different services, products. Like I love, starting new things. And I've done a lot of this on Twitter, as anyone here who's followed me for a while will know. So I launched a car buying service earlier this year, which was very short-lived, but it will, hopefully it will come back with much better service soon, but we'll get to that later. More importantly, I launched this car buying service early in the year, and I could tell first of all, people signed up for it like crazy, but more importantly, the reason people signed up for it, that was what interested me. I said, well, why? And it was clear that people signed up for it because they trusted me. And I think that if more dealers simply put out, value and educated people and with transparency, then they would, ultimately, they would become a lot more successful because that's what people want nowadays. Think about yourself, right? Like if someone tells you their playbook, they share the inner workings, right? Like ultimately you trust them, you want to give them your business. And so I think that's really been my playbook, really simple playbook. Just be open, be honest, be authentic. And I'm trying to be very authentic. I say some things that sometimes are controversial, sometimes that are just plain dumb, personal stuff that is. But I'm just being myself, right? Like I can't run this account and do it for many years to come if I can't once in a while tweet about, me having a funny story while I'm pooping and the kids are crying outside the door. So I just try to keep it real, keep it authentic, be myself, and then, bring value along the way.
To be clear, you're not pooping now during this Twitter space.
You don't know that.
That's true.
I'm just kidding. No. Okay. Michael, I got to keep you on your toes.
No. Well, that relates to, that's a good transition to the word opaque, which you threw out there, sort of car dealerships. I try my best in transitions. On this point about kind of the opacity, so to speak, of the space. All right. So first of all, full disclosure, I don't really track this very often. I'm actually not a super hardcore car guy by any means, but I am curious to learn more about why you say this part of the economy is opaque. I mean, people see the car, they see the sticker, they see the price, they go in, they see the car, they test drive the car, they see it online. Why did you use that word opaque?
Yeah, look, first of all, dealers make money in many different ways. And some of those ways, like, a price of a car may be a pretty transparent, commoditized thing, right? You go online, again, assuming it's the right price and there's no markup added in the back end or a fee that's not disclosed, then, that's the price of the car. But when it comes to the behind the scenes, how does the lending work? Do dealers get paid from lenders and the financing and the aftermarket products that you're offered to purchase? Should I buy them? Should I not buy them? It's just such an infrequent purchase. The average person, I think the stat is like roughly 1 in 10 people buy a car each year. And so, yes, lots of people buy many cars each year, but it's still an infrequent, purchase that happens once every 4 to 6 years on average. And so, it's just something that people are not as comfortable with. And it's constantly changing, or certain elements are changing, but still people don't really know what's happening behind the scenes. And it's also an extremely discretionary purchase, right? It's like arguably the second largest purchase most people make in their lifetimes. And so you don't want to fuck it up. You don't want to get stuck with a bad product. You don't want to get into bad terms. And so I think that, people want that trusted voice on their side and at least to arm themselves with some knowledge. And, typically you see that a consumer, before they make that purchase, they've done at least like 30 days of homework research. They more or less know what they want. And then they're coming to the dealership well more prepared than any salesperson, right? Because you've like dug in onto that 2018 Toyota Corolla like really, really well. You know everything about it. Where like the piece from the left fender was manufactured probably. The salesperson doesn't know that. It's, yes, you have some really specialist salespeople that know, their products extremely well, but that's more rare nowadays. And so you really get a consumer that's more well prepared on the product, and then they're coming to the dealership, but what they don't know as much is really the inner workings. And, should they buy this? Should they do that? Should they get financing here? Should they go to their credit union? Or, many, many other questions that I get asked all the time.
So it used to be the case that, if you wanted to know where the economy is going, you would track Ford or GM, right? You'd look at the behavior of the auto companies because they were a big driver, pun intended, of economic activity, growth, a signal. Talk about how has the importance of the auto industry changed in the last several decades from a signaling perspective on the economy?
Yeah, I mean, it's been tremendous, I think. And even if you just look at the last 3 years, right, the auto industry has been an insanely powerful leading indicator for the economy. And from everywhere, I mean, you have lending, you have just CPI inflation with inventory vehicles. It's a pretty important component. And so I feel like the last couple of years since COVID, the auto industry has really become this kind of focal point, and for good reason. I mean, the cars have just the way they've appreciated. It's just been a shock for many people, and it's a completely different market than we have today than we had 3 years ago. Used cars, new cars are both up roughly 40 to 50% over the last couple of years. Today in dealer inventories alone, you have like 30% fewer cars than you did a year ago. And so, we're seeing more pricing pressure on the used side. And I think, but, that's just two specific stats that I'm mentioning. But overall, the car business it's always been an indicator for the economy, but in times like this, it's a massive indicator, especially when everyone is looking so closely at stuff like inflation.
All right, so let's expand on that in terms of kind of the current state of the automobile industry, and let's distinguish between the used and used side of things. I would be curious to know if there's maybe a different signaling message when you look at used prices versus new cars.
I don't know if there's a different signaling message. I think that what's important to know is that, look, new versus used is very different, right? Because you need new cars to be bought in order for them to become used cars. And if new cars weren't purchased over the last 3 years, or if new cars were purchased, or if fewer cars were leased, then inevitably you're going to have an issue on the used side, which is what we're facing right now. Right? I just mentioned that there's, dealer inventories are down and depleted, and it's causing real issues. Rates is causing real issues. But I guess if we just have to, if we take a step back and, people are like, okay, well, what the hell is going on right now, right? I'm an alien. I just fell on Earth. I have no idea what's going on. Give me kind of like the snapshot. Well, new cars are improving. I think overall, they've been consistently improving. New car production has been consistently improving. It's not equal across the board. I've mentioned that many times, right? Because you have certain manufacturers where demand is extremely high and they're underproducing. And so the two of those forces combined, such as, let's say, Toyota, it's still keeping inventory extremely low for them. And so they're still, very much in short supply. But on an average, across the nation, you are seeing that new cars are starting to rebound. And, right now, actually in March, I just tweeted this out. In March was the first time in over 20 months where the average new car was sold at MSRP or below. And so, it's really good news because we're seeing consistent progress on that side. And, overall, you're just seeing that new car dealers are faring out really well, or franchise dealers. There's no shortage of new car buyers. But it's also important to remember that, other than just the purchase itself, new car franchise dealers have other revenue drivers, profit centers. And so we'll get into that shortly. On the used side, though, new side is looking pretty good, but the used side is not looking as good at all. We're just now getting into that point where it's been 3 years since we had lockdowns and shutdowns and all that. And so, used inventory is continuing to drop, or at least available inventory, as I mentioned. Roughly, we're right now down about 30% year over year, close to 2 million used cars in inventory in dealer inventories. Now, you have to remember another thing, right? So we were starting with 2 million cars on used car dealer lots. But the other issue we're having is that those 2 million cars are not all, $20,000 cars or $15,000 cars. Like most of them are above that and they're more expensive. And you're running into a challenge here where the average used car interest rate or used car loan interest rate in the US today is 14%, right? It's just wild when you think about it. That's the average, of course, not median, but it's still extremely high. And so when you couple record high interest rates, fewer cars in dealer inventories, used cars available altogether, and you add the pressure on used car dealers themselves, such as inventory carrying costs are rising, financing availability is declining for consumers. All these forces together have just brewed this perfect storm, which I'm going through in real time right now, and it's really, really painful. But we're seeing it's extremely tough to sell used cars. And so, the used car market is not in a great state, although prices have held up. I think that's the only, imagine if prices right now dropped like 20% in 3 months, like that would be just a disaster across the industry. But I think that's the only thing that has, at least, the fact that there's been so short supply has sort of buoyed prices a bit and, helped kind of used car dealers get through this slump over the last couple quarters.
But I got to assume a lot of that was just pulled forward from the insane demand post-COVID, coupled with the supply chain disruptions in general, and all these headlines that we saw, around how used car prices were selling for more than new car prices of the same make and model. So, when does that dynamic maybe sort of run its course?
So I don't know. I think that's your guess is as good as mine. What I can tell you, again, if you're looking at like the quote unquote experts, the economists, they're claiming, Cox Auto, which is, massive automotive conglomerate enterprise, they put out, one of their analysts stated like 2026. And that, they're anticipating that the used car madness starts to, ease. And I don't really know what that means, or we get back to equilibrium. So it's super hard to tell on the used car side because it's so dependent on the new car side. But, we're going to have to see how, if there's a massive drop in demand, then that could impact it. Other things could impact it if rates continued rising. But at the end of the day, your average used car is still cheaper or less expensive than your average new car. And again, I'm not referring to, like a super mini, like just a micro car where you can fit two people and you have no trunk space, right? Like people have families, people can't just buy these like super small cars. And so, they need a sedan at the minimum, 4-door, full size sedan. And so that type of vehicle, if you're getting it for 20, 25K used, it's still cheaper than if you were to go buy it new. And so that's what's keeping the used car market also afloat. The fact that, new car production costs have risen. And so, when new car production costs rise, then you just can't expect that used car prices will ever get back to what they were pre-COVID, although we should expect them to decline.
How much of that demand for used cars is generational in the sense of, younger generation wanting to simply reuse things that are already created because it's, maybe better for the environment than constantly supporting new production? I got to assume there's at the margin some demand that comes from that sort of mindset.
I don't think so at all. I mean, I think it's a very, utopian perspective. I think, we're living in a reality where people need four wheels to do something, especially people that are buying used, right? Because look, the new car has become sort of like a luxury good, right? If you look at, just in December, nearly 1 in 6 car buyers that financed a car paid over $1,000 a month. And I think it was 1 in 4 cars that were sold had an MSRP over $60,000, right? If you go back like 5 years ago, that was 1 in 13, right? So 1 in 4 buyers, or 1 in 4 cars that was sold in December had an MSRP over 60,000. 5 years ago, that was 1 in 13. So the point I'm trying to make here is that the new car has sort of become like a luxury good, right? It's no longer like anyone can just, buy a new car and they're not, any car is just dirt cheap. I mean, the thing is up like 50% in the last couple of years, right? And so I think the reality is the used car is simply for, everyone that can afford that. And frankly, I think it's people that have much fewer options, right? I think the people that are maybe looking for that, I want to go green or this or that, like they're more likely to buy, maybe a new EV or something. And EVs just had a record quarter in Q1. There was about over 250,000 of EV sales in Q1. That's an absolute record quarter. And so EVs are also, on the rise. Of course, there's lots of, government backing it up and with the rebate and all that. But nonetheless, I think that just the used car is where anyone is flocking that needs affordable four wheels. And it's also coming at they're also buying a shittier product. I mean, nowadays, we used to sell, I'll give you an example from our dealership. I mean, we used to sell used cars that our average used car, let's say, it was like an off-lease car, right? 40,000 miles, 35, 3 years old. Now, in order to manage through affordability, you have to go deeper, right? You have to sell that 5-6-year-old car. Maybe it's got 70, 80,000 miles. You have no choice because the demand is there, but the supply is not there, right? And that's the biggest issue you're having. If you gave me today, 1,000 cars that were decent shape, quality, decent miles around, around 20 grand, I mean, I would sell all of them, but you can't get it. And so that's the issue we're having. And couple that with financing and just consumer availability of financing for consumers, which continues to just shrink and narrow and just, all that makes this perfect storm where it's just a really tough used car market.
All right. Okay. So that's actually a good transition. So I want to hit on that auto lending point. Let's expand on that a bit more. First of all, when did the auto lending side start to become less available in general? I saw the tweet that you put out, which I shared the Nest around Capital One pulling inventory lines of credit. I assume we're going to see probably more of that. But lay out some of the historical dynamics of auto lending, how it works for those that are not familiar, as far as the opacity on the back end, and what's been happening more recently.
Yeah, happy to. And I'll throw a quick plug I did do a podcast on this and it's in my link in bio. So follow it along. There's a really good episode coming out on Friday, which I think you'll find super interesting. But yeah, so I've been speaking a lot about this. And like I said, my goal is, I share, a lot of information comes my way. And I look at myself sort of like a filtering mechanism, right? It's sort of the point we've gotten to, right? Where it comes to me, I filter, I look at the data, I look at the anecdotes, I share it with the world, right? Because obviously I have this great reach and it really does get lots of exposure once I put it out on Twitter and wherever else. And so I was speaking, and I'll give an overview on lending, how that works as well. But specifically with, what I was chatting about the other day was I was just saying, hey, Capital One is pulling out of floor planning, which all that means is a fancy term for like an inventory line of credit for a dealer, right? Because dealers, at least most dealers, don't own their inventory. They have it on a line of credit, and they pay a certain percentage to the floor plan lender, and then they sell the car and they pay them back. And so, around December, I would say, we started seeing that credit began to tighten. The credit was still, the pretty average or, consistent all the way through Q4. But then December, we started seeing credit start to tighten. Now, at the same time, you have to remember that in 2022, used car prices or values actually fell every single month throughout the entire year. Right. And so it was like, okay, like what is happening? Like, is this going to ever change, turn around? Well, suddenly in January, used car prices started rising again. Your guess is as good as mine. Why that happened? It could just be driven by seasonality, dealers stocking up, people got through the holidays, many reasons. But the point is prices started rising again. Now, lenders started to really tighten their belt around that time. And I would say Capital One Auto Finance, which is a major player in auto financing, was probably on the forefront of that. They tightened their belt the fastest and the most, and really the earliest. And so in the last couple of months, we've seen a lending continue to tighten, specifically on the used car segment, or more of like near and subprime consumer segment. If you look at the data, surprisingly, it would tell you that credit has actually loosened for car buyers. But it's a very important distinction that that's only the case on the new car side, and it's not on the used car side. The used car side has actually gotten a lot tighter because the used car side skews towards a more near prime or subprime buyer. And so credit has gotten a lot tighter. I mean, I'm sure you saw the Wall Street Journal report the other day where it was like credit in March or so, in the last 2 weeks of March, got tighter by like $100 billion or some crazy number.
Sorry, not to interrupt, but actually, I was thinking as we were saying that, it's like, that's actually a really interesting distinction. I hadn't made that point, but basically what you're arguing is that there's almost like a repricing of default risk that's happening, to your point, on the used car side of things, because the nature of those buyers are likely to be more indebted, have more risk. So there's a credit widening spread effect that's happening.
Yeah, I mean, 100%. And all these lenders are tightened. Now, remember, dealers, you have to think, a used car dealer, right? Even Carvana. And I say even because, people think, oh, Carvana, big, billions, nationwide, fancy schmancy. Like, used car dealers typically skew near prime, subprime credit. That's just how the world works. And it's every used credit. It's CarMax, it's Carvana. Of course, different operations, some have better credit than others, but that's just the reality. Typically, new car dealers skew more better credit. And so anyways, we saw last 2 weeks of March, just the tightening get really aggressive. And what Capital One did not announce, as being a major auto lender, is that they're pulling out of inventory financing for dealers end of March. Now, why is this important? Well, again, these things are all breadcrumbs, right? Nothing's important until everything's important. And, it's not one thing that, kind of the straw that breaks the camel's back. It's a lot of little things that compound, right? And so I spoke to some dealers that said, like, one dealer reached out to me from Texas. They're a group of about 15 stores, and their CFO. And he's like, listen, I need to, we need to refinance now. And yeah, it's concerning, right? You have 90 days to go refi. And you have to find, another lender in this, tightening environment. It's tough. And so, and he's not the only one. I mean, I spoke to other people as well, but I think the point is, like, these are all breadcrumbs that show you kind of where we're heading. And when rates rise and all these things happen, right? Like, the demand is still there. People will still come to shop. But when floor planning, right? When dealers don't have access or capital to acquire inventory, that's when you really start to see prices decline. Now, Capital One is not a major player in floor planning. They are a player, and we've shopped them before as well. Like, we've spoken with them, so they're a serious player, and they're also very selective. But again, it's just another important thing to know, that you're seeing this continued tightening across the board, and it's disproportionately impacting the used car side of the business. And so that's where I think most of the risk is today, because look, new car dealers, franchise dealers, they have, they get, especially on the new cars, right? They get floor plan assistance. They work with their, the car manufacturer. So let's just say, Honda or Nissan or whoever, they work with them, and, there's floor planning credits. It's a lot easier, and it's a lot less expensive to finance this inventory, but it's very different on the used car side. And, you're really relying on that in order to keep your operations going.
I'm going to probably test this myself because that goes back to the earlier question about the signaling effect being different among used cars and new cars. And everything you're saying makes a lot of sense to me. If it's a tell on the subprime type of buyer, and if it's a tell on a degree of spread widening between credit availability of new cars and used cars because of the type of buyer, there might be a leading aspect to that, when it comes to risk assets in general. That's sort of where my mind is going and hearing you.
Yeah, look, it's been a problem for over a decade, I would tell you, and I can tell you also anecdotally, like that since from the last couple of years, like you could just tell that lots of people on the team are burnt out. I see this, I have people that have been with us for, like 10 years, 7 years, and just, the last year since 2021 and the craziness, the volumes, I mean, technicians are burnt out. And, it's not everyone, of course, but the people that, the master techs, the vets, they're tired. Now, more importantly on, incoming new talent. Yeah. I mean, if you are, like as a used car dealer, the service we don't do retail service. It's not a big part of our business, right? We mostly work on our cars in order to retail them. Of course, the franchise dealer is just a huge revenue driver for them. And it's a great one, right? With nice fat margins, but you definitely have this issue of just, talent. And I think the best kind of fixed operations directors or service directors that I've been exposed to are working with the trade schools, training them young, bringing as many people as they can for apprenticeships, offering overall a really good work environment and ability to learn and grow. And, they're doing fine. They have the people because it's a good work environment. So I think, look, there's always going to be this kind of dispersion, and you're always going to have some dealers that are struggling and others that are able to retain that talent and get new talent. I think the other thing that I'm looking at is, like there's a company that I'm a small LP in, and they're called RoboTire. And this is just one example. There's other companies that do, different things. But like, for example, what they're doing is they're actually, they built this robot that replaces tires. Right. And so it's pretty remarkable. It's already being commercialized. If you Google it, you can see a video of how this works. But, there's new technology emerging, which is going to, hopefully lighten the load, over time. I mentioned EVs, sales are skyrocketing. They need, some less maintenance. They don't need oil changes and stuff like that. Of course, they need other types of maintenance. But the point is that, like there are different types of technological advancements happening, which, they can at least leave us feeling hopefully optimistic that, things will work out over the next decade or so. Well, if I've learned anything over the last couple of years, it's that all our predictions are all shit, and the smartest person can barely tell what's going on right now. But I think, like I mentioned earlier on in the pod or in the space, like if you look at what the quote unquote experts are saying, and if you look at the data, and if you just use some common sense, the shutdown started happening about 3 years ago. We're kind of entering this period of supply where it's likely going to get even tougher over the next certain period of time. I think the counterforce to that is, again, the fact that it's the cars are just much less affordable, financing is much less affordable, and so maybe that's going to outweigh the fact that there's just fewer cars available, used cars available, and that'll bring prices down. And I don't think anyone's arguing that prices are going to come down. I think what I've been saying is that we're not likely to see pre-COVID prices because, again, the cost to even produce a new car has gone up and whatnot. So, we are going right now. There's some indicators showing that prices are starting to cool. There's two major things happening on the wholesale end specifically, which is that you're seeing sales conversion at dealer auctions just started declining at the end of March. Now, all that tells you is that the seller is not getting the price that they're looking for, and the buyer is not willing, to pay, right? The bid ask spread there. And so you kind of have this, stalemate, and that doesn't last very long because sellers want to get rid of that inventory because, otherwise it's going to depreciate on their balance sheet. And so the first thing you're seeing, like I mentioned, is sales conversion is starting to decline, which is typically a positive for prices starting to cool. And then the other thing you're seeing is that price retention near the end of March at Manheim auctions also dropped by about, I think it was like 20 basis points. Now that's very, very little, right? That pretty much means that if you had a $20,000 car, And at the end of March, the market value of a car was $20,000. Well, end of March at auction, it actually sold for like $19,960, right? Barely. I mean, it's pretty much sold for the market price. But the fact that that trend is reversing and you're seeing an inflection point where prices are now going the other way, it signals to you that, okay, maybe prices are starting to cool. We shouldn't expect, a significant cooling immediately unless other crazy stuff happens and, other lenders start pulling inventory financing and whatnot. But we should expect prices to continue declining, pretty consistently throughout the year. And, hopefully getting back into a normal rhythm of, depreciation, which you'd expect with a used car. CarMax, I didn't look too deep into this, but I know that like the CarMax Auto Finance earnings declined about 36% year over year in Q4. And so, multiple reasons why that's happening, but, it's driven by worsening credit and narrower spreads and stuff like that in the markets. And so financing is definitely taking a hit. Again, people finance overpriced assets. They had to buy cars that are older with higher miles. You're just going to see more defaults and more risk. I'll get to Ally shortly, but I'll also mention that, when you look at the industry as a whole, we're actually, the default rate is still not, it's still pretty decent. I think it's really important to, stay level-headed and, to look at it from a very objective perspective. There's a certain segment of consumers, right? The consumers that are 6 days past due. That's the segment that, and again, this is all like public ABS or asset-backed securities. Like that's the segment of consumers where you're starting to see the delinquency rate start rising, right? It's at about like 1.9%, which is, higher than it was in 2009. But the default rate is pretty low still, which the reason for that being that, lenders are working with the consumers, they're offering extensions, and, we're just not seeing defaults yet. Now you can say, well, that's kind of artificial. It's fake. Well, yeah, I mean, any intervention we've seen over the last 20 years has been artificial and fake, but that's just the reality of the market right now. Right now, if lenders weren't offering these extensions, maybe the default rate would be much higher. But all that said, so, it's definitely an area I'm keeping a very close eye on. And it's also, again, you don't have to be smart to think that, people have less disposable income. Household savings are going down. Interest rates are going up. We're not printing money left and right and offering stimulus checks. No shit that people are going to, there's going to be more delinquencies and repossessions. It's just obvious, or it should be obvious. So that's what we're seeing, and we're keeping a very close eye on it. With regards to Ally, I've been public about it, and it's all public knowledge. They have a subprime lending program. I would say, yeah, they are picking up some slack, especially from like the capital ones, as is Santander. I think Ally's probably being a little bit more aggressive right now. But again, I don't have any, anything specific to say other than that, they've been a good partner. They're still buying, as are all the other lenders. But you're just definitely seeing this continued tightening over the last couple of months specifically.
I'm curious, given your expertise and experience and everything in the space, do you yourself invest in automobile stocks, or are you doing
No.
the sort of, as I say,
No.
right? It's diversifying away from that.
Well, yeah. Number one, yeah, I definitely don't want to be like, fully just correlated to one industry, one segment and all that. And I can also tell you, like, my Ameritrade, I keep it empty. I just, I'm personally not so interested in owning these equities. I also talk a lot, and I don't want to ever be in a situation where I say something about some stock and then I own it, or I've owned it, or I plan on owning it. I don't even want to get into that. And so I have, no public equities or anything like that other than, 401k, which, has stuff like that, IRA, but no, I don't invest myself.
Yeah, no. And by the way, I'm glad you said that. I'm also glad that, you said, you made that point. It's like, when you look at, predicting the future, all these predictions are shit. And I said to myself, you know what? This guy is perfect because he's the exact opposite of FinTwit in the way that everybody often refers to the unknowable tomorrow. Since you mentioned a little bit earlier, I'm curious, just sort of on the periphery, I'm sure you come across a lot of really interesting technologies, things that might be game changers in the automobile industry and the dealership side of things. Now, any sort of really interesting, unique things that have come across your desk that really kind of get you excited, that could be like real disruptors?
And you're referring just to automotive or mobility and like technology in general?
Yeah, in general, right.
So this is exactly the podcast I recorded this week was with Steve Greenfield. He's the founder and general partner at Automotive Ventures. It's a leading, early stage venture fund for mobility and auto tech. And this is actually some of the stuff we discussed. It'll be out Friday morning. And, I'll just mention like one thing. I was asking him, what are some areas you're investing in, and where are you looking at, what's interesting, and I think he really piqued my interest when he really believes that from the conversation that we're going to get to this point where the subscriptionification of everything is going to come to the car. And I know we've seen kind of snippets of this with BMW, the heated seats, but it's super interesting to hear him as, again, an early stage venture investor on the forefront, specifically looking for these companies that are at the forefront of this. And like, I'll give you one example, right? We're dealers, so we buy cars at auctions. And when you purchase a car, you appraise it, right? That's how you know its value. You have, book values, market values, and whatnot. Well, in order to appraise a car, you need to know what features are in the car, because if a car has a navigation system that's active versus one that does not, then you're going to pay more for it. It's more valuable. And we're going to get to this weird place where, suddenly, you, Michael, you have you drive some car and you sell it. And then, your car is souped up with every feature under the sun. You pay an extra $500 a month for that. Or maybe you just activate it during the summer or whatever. And then you sell it off, but then you deactivate all these features. Now you just lowered the value of the car. You know what I mean? And so when you start attacking on all these services, it's going to be very interesting to see the technologies that people build. Like Steve mentioned something specific. He's like, who's building the clearinghouse for that? And there's other things that are going to be built, but I think it's going to be a whole economy. Yes, the services are going to come to the cars even more so than they are now. You see that stuff like Apple CarPlay, where all the data shows that people are much more inclined to purchase a car if it has CarPlay. And so Apple has sort of commoditized, the entertainment console in cars, right? Taking more margin away from the car manufacturers and making every car more similar to each other. I do know that GM recently parted where they said they're going to get rid of CarPlay, but all these things combined, I think just the subscriptionification of these cars is a very interesting area to look out for. And, like I mentioned to Steve, I was like, well, this sounds to me like, as an example, like Coinbase in like 2010 or 20, whenever they launched, I was reading some article about this, and, it was a very like fringe thing at the time, right? Like when crypto and all that launched, it was like, what is this? You're building a marketplace to trade these like virtual currencies. And then boom, like they went public a couple years ago at this insane valuation. Of course, they're down since then. But the point here being is that I feel like that's the point we're at right now with the subscriptionification and kind of like everything as a service when it comes to cars. And, in 5 to 10 years, it'll be a much more common thing in pretty much every car that we all buy and sell.
Maybe for the last few minutes here, I'm curious to hear your personal opinion on if we're all going to be driving autonomously. I am very skeptical of these narratives that people are not going to be driving. It's all going to be entirely algo driven, just because people like to drive cars. I mean, there's enjoyment from doing it for a lot of people. Do you think that we're going to have this kind of Jetsons type of era in 50 years where nobody's going to know how to drive? It's all going to be automated?
No. Look, I think that it's autonomous driving. It has its challenges and, technologically. And I don't think it's anything we can't solve. I think at least most of the way we can solve it, and we have solved lots of it and all that. But I think the next step here is just like regulations. And I'm not an expert in this at all. I'm just not betting, anytime soon over the next decade that this is going to be a reality and something that's just like ubiquitous everywhere. And maybe it happens in some other country before it happens here. Probably doesn't. And the technology will continue improving. But I'm just, I've had the AV conversation for, a very long time, many years. And I always just, kind of punted, kick the can down the road and say, it's just not, I don't view it as any reality that's going to happen, really like something, ubiquitous anytime soon. So I think the short answer for me is no.
Yeah, I would personally tend to agree on that. Any other thoughts that come to mind, things that you think people are getting wrong or maybe not focusing on that they should when it comes to the car buying side of things and consumers? The other part of this, of course, is that in general, we know that a lot of these savings have gone around trip post-COVID. So presumably consumers are going to be tighter with their wallet. But anything else that's kind of interesting from your perspective that people aren't really focusing on?
I just think that, the consumer overall, like I said, we're still seeing demand. Frankly, like our, incoming leads. So like, like inquiries in March was up about 15% over month, right? But sales was down roughly 20 something percent, right? There was a big drop. And again, driven by financing and financing availability. So, you're still overall seeing consumers, demand is there. And I just think, I'll try to keep everyone posted as things happen. I think the most interesting thing for me has just been how well the car business has predicted, or at least, been a leading indicator for other things happening in the economy. And again, I didn't plan on sharing info and kind of going this direction, but it sort of just happened. And I was like, wow, it got to a point where I was seeing things happen. Like I would see, in my store, I would see in our store, like, we'd outperform. And then like I would look, I'd see, over some quarter or a month or whatever. And I would see like, CarMax, Carvana earnings come out. And it was like so similar. I was like, oh my God, this is like cheating. Like I see like what I can almost predict what's going to happen in the broader market. And then that has implications and whatnot. And so I just, it's crazy how correlated this industry really is and how good of a predictor, you have the consumer, you have lending, you have all these aspects that are built into the car business, and they really tell you, or they can inform you and tell you what's going to happen with the economy. So that's pretty much it.
I think that's a good place to wrap this Twitter space up. I have to get ready for another one I'm doing at noon Eastern in literally 10 minutes. Everybody, please make sure you follow Car Dealership Guy, at the Ad Guy Dealership on Twitter. And again, this will be an edited podcast soon enough. Appreciate your knowledge, CDG. I was going to call you Anon, but I think it's kind of weird to say Anon when you actually talk to somebody. So all good. Thank you, man.
Thank you, Michael. Take care. Bye.